Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Nathan, thanks for taking some time to join me on the podcast.
No problems, mate. I wish I'd have been a bit more casual about it. Casual Friday t-shirt.
Yeah, it's Friday. We're recording in Sydney. It's a lovely day too. So it's all about the rays and the skin for me, mate. But not really. I'm a Victorian, so the sun is allergic to me. But yeah, it's my pleasure, mate, having you here. And looks like you're at home in a nice shirt. I'm in the office in a casual t-shirt. So there you go. We actually met in passing. You may not remember this, but we actually met in passing many years ago when you were with a prior fund, and we're talking global companies and the like. And you really stood out to me as someone that articulated messages really well and thought really clearly about investing. So I'm really excited to go over some of that ground, but also a lot of the other stuff that I don't know about you. But maybe to get things started, I got a few quick fire questions here, if I may, and these are a bit of fun, a bit of tongue in cheek. So the first one, Nathan, is if you could pick one skill to achieve expertise, like to get to that level and you think, okay, I'm pretty good at this, that 10,000 hours test. So not like invisibility or something. What would it be?
Look, I think we already have all these superpowers as humans that we just are unaware of. It's a bit like the ASX song lyric that said, we all have wings, but some of us don't know why. And I think those superpowers are things like independent thinking and having grit and determination. And they're all the things that get you anywhere. And so I can't come up with anything particularly interesting, but I find that just not giving up. I really gave up at 30 on getting a job in as an analyst, as an investor.
Oh.
And I was all set to move to Melbourne. I quit my job and I was about to go. And my wife said to me, shouldn't you find out about that job at Intelligent Investor where you've had about 5 interviews? And I said, they would have already hired me if they wanted me. And I sat there at my desk at Deutsche Bank. I hated my job. I just hated it. And I've been an accountant for 10 years and I hated every minute of it. And I said, and I thought to myself, oh, you might as well go and find out. And then I got offered the job, but it was a 40% pay cut. And I had a wife and a child at a young age. I was 30 years old, didn't have any money. And that was a really big decision. And I actually got sacked by my boss about 12 months in. And then within 18 months, I was the CEO of the business. So I've been learning the guitar for 2 years, and I find it just comes down to the grit, determination to keep going. And if you don't have that, you're not going to get anywhere with anything.
I love that. That's great. You've already got it, so I really like it. Second one, mate, is a bit of a false choice, but if you could only choose 5 companies, but they're public or private, so you could only have 5 private or 5 public, and you had to hold them for at least 10 years, which way would you go?
Yeah, so private enterprise. So I've seen this. I'm not going to answer this whole question because we'll be here all day, but I've been involved in Intelligent Investor since 2006. And before that, I'd worked at 2 very large companies. One was Carter Holt Harvey, which some people might know is a forestry company and based in New Zealand. And that was a very big company. And then the second one was Deutsche Bank, which was actually the largest bank by assets on the planet at one point, before the GFC, when it quickly eroded and became one of the smallest investment banks on the planet, at least equity-wise anyway. And, I've seen just the bigger your company is, the more responsibility you've got, and just the tougher it is. It takes an incredible people, and I think an incredible type of business and just behavioral traits to go from someone who's very skillful at something and starting a business to then becoming a manager and growing a large business. They're just completely 2 different things. So in terms of, a private business, I just personally have no interest. I don't want to be involved in a private business. But if someone comes along and says, look, just invest a certain amount of money and essentially, pre-IPO, for example, my wife's in a very good little business at the moment, and she's got some equity in that, which is a competitor to Baby Bunting, and they're going really well. So that's probably the first sort of, I guess, eye-opening or private experience I've had with a private business, and I imagine that business is going to go very well. I'm very confident in that. But the thing about listed companies is when something goes wrong, you can have your money back in 2 days.
Mm,
That liquidity is just enormous to me. And the types of businesses that you can buy on market, even though it seems like there's less great businesses today than there ever has been because they're just getting taken out and taken off the market. Personally, I just much prefer the listed businesses, and obviously it's a huge bias because that's what I've done
mm,
for so long now. But just that liquidity when something's gone wrong to get out. Whereas when you're in a private business, if something goes wrong, and you either have to adjust your whole business or you're just fighting against a trend that you cannot turn. Like that's a horrible situation to be in, and
mm,
I would never want to be in that. So I'll go with my listed companies. And in terms of, I'll just rather than pick all the companies, I'll just say generally this
for sure.
idea of long-term investing is is really difficult, I think, in the modern day, even more so than it's ever been, because the great businesses, at least the business we used to think were great, but things are changing even for fundamental, or sorry, more simple businesses like Coca-Cola or Gillette. These businesses have got competitors now. Now you've got boutique ways to buy razors and cheap way to buy razors, and you don't necessarily need 4 blades on every razor, as
Mm,
people are finding out. So you don't need to keep paying all those sort of prices. Coca-Cola has only done any good in the last 10 or 15 years because of water, of all things.
mm,
And now you've got ESG, and there's pressure on the cans and the wastage in the bottles. So things are changing. So to sit there and say you want to own a business for 10 to 20 years is just such a difficult thing to say. And we're going to talk about this company later, but it's interesting. One of the things I think has been very helpful to Macquarie Group, which was really just used to be an investment bank, and now it's more of a fund manager.
mm,
But that ability to take money and invest it where you think you're going to find the best returns. So I guess you call that flexibility or nimbleness, whatever you want to call it, is really valuable in the modern world, and it's unique. You don't find many businesses that can do one thing and then go and do something else. But I think that ability where you can find something small, where you can be a bit agile, they're the sort of traits you're looking for. But other than that, it's that diversification you can have in the portfolio is just a great bonus, and being able to sell and get your money back.
mm.
Give me the listed businesses any day.
I like it, mate. Very well rationalized there. I like it. So second last quirky question, which is, I don't know if there's a quick take on this one because we could go for days on this, I'm sure. But in your opinion, does short selling work?
Um, That's a great question. I haven't seen many, if any, great fortunes made with short sellers. It might be a part of their strategy, but all the huge money is made on the long side, and that's why you don't see short sellers on the Forbes rich list
Mm,
or the BOW rich list. In fact, if you were to copy those people, generally they own one business and they have everything in it, and
mm,
they're all in. They've got one egg in their basket, and they look after that egg. And that's very different from what you get taught in investing, where you have a diversified portfolio, and most fund managers and ETFs have hundreds, if not thousands, of companies
mm,
portfolios. So it depends really what you're trying to get out of it. And for me, we talk about swinging for the fences sometimes, and I think
mm,
I'm probably trying to do that personally. But with the funds we manage at Intelligent Investor, I find once you get past 20 stocks, the ideas tend to get pretty poor, and you're not very excited about them. And the research shows, even for fund managers that underperform, their top 10 stocks actually really perform very well.
mm,
It's the fact that they're forced to be diversified, and that ruins their returns. So I think there's some important lessons there for how you handle your money.
mm. I like it. All right, last one of these little questions, which is, can you describe the macroeconomic environment in a couple of sentences?
Yeah, complex. That's one of them, and you can't get blood from a stone, and I think that's what we're learning now is
Yeah.
they've tried these monetary policies where we tried essentially to bend the system because we didn't like having to take long term hard decisions. We didn't want to take that pain, so we bent the system, and we did zero interest rates and quantitative easing, and now that's snapping back, and we're paying the price for that, and that was
Mm,
completely expected, and that shouldn't surprise anyone. And we're coming down from a 13-year bull market in everything. It's, just not stocks. It's almost a bit like the Roaring Twenties, where just everything went up and everyone's leveraged, and now the bill's coming due.
mm. Um, yeah, yeah. I mean, that's just being realistic. It's pragmatic, isn't it? It's a pragmatist view of it, things, if you think about that. It's just interest rates lifting all boats. Um, so Nathan, You mentioned before that you spent a long time as an accountant before becoming an analyst. Did you have a background or did you have some sort of grounding in investing or business as a kid or as a, young adult? Was that part of your DNA?
Yeah, it's interesting you say that because all I remember, and I don't know what caused it or when it started, but all I remember is always just wanting to be an investor and understanding business. And the only thing I can really think about was my parents were divorced when I was 10. We moved into government housing in country
Right.
South Australia, Mount Gambier. So we never had any money. I mean, you divide no money into two, you have even less. And it was hard. Like we had no money. So, but I mean, most of my mates were the same. You didn't really notice it too much most of the time. But I noticed it more when I got older. And it really drove me to find some other way to have money. And, all I ever wanted was my financial independence. I didn't want a lot of money. I just wanted to live my way each day. And I knew that I actually wanted $1 million by the time I was 35 because I knew I wouldn't be able to work for someone else by then. And it turned out by the time I got to 35, $1 million wouldn't even buy you a two-bedroom apartment in Sydney. So I needed to aim higher. But in terms of the business grounding, the first one was I used to get up early in my school holidays and go and work with my dad. And he used to drive a truck around the southeast of South Australia and Western Victoria delivering Schweppes drinks. And he was a really hard worker and a great sportsman, played state footy for Tasmania and first class cricket as well. And he would get up at 2 or 3, 4 a.m. and go off and get the drinks dropped off as early as possible. And I'd jump in the back and sleep and wake up about 7, get a cheese and tomato toasted sandwich when we were almost home. And when we got back to the depot, I'd count the money that he'd collect. Back in those days, you'd have the old $20 or $50 notes to count. So, cash economy.
Mm-hmm.
So I'd sit there and count that up. So that was my first dealing with money. And my dad always told me, even though we never had any money, that how important it was to save. But I even remember just looking around the depot and seeing the different jobs that people had. I knew my dad had to pay for the truck himself. I knew the hardship of what the divorce was like. And I also remember looking at the wooden pallets around the depot. So this is over 35 years ago, and thinking, geez, is that really the best thing they've got to move all these crates around? And here we are 4 decades later, and like Brambles shows you that, yes, some things don't change. So there's a lot of business lessons in that. And for some reason, I was always understood it. And I don't know when the investment bug kicked in, but I just always knew at some point that investing was this place where if you're really patient and had grit, which I thought I had anyway, and you're prepared to go against the crowd, and you could actually do analysis yourself and come up with better decisions than whoever the average investor was. And if you just hung on for the long term, you made money. And I didn't read any books. I wish I had have. And and I just understood that, but I did everything wrong after that. I sort of had the right start. I invested early, and then just went off and got my meal tickets and tried technical analysis. And I was more focused on getting meal tickets than I was actually analyzing businesses. And that's, if I told anyone, like, if you actually want to be an analyst or an investor, don't worry about the meal tickets, just go and invest the money and analyze the businesses. Because if you want an interview with a fund manager, they're going to ask you what your 3 best ideas are, and you need to go through those best ideas. And that's why my CV just never got anywhere. So that's why I had to take the 40% pay cut at Intelligent Investor.
So obviously that early grounding in business, seeing your dad get up early and count the money with him and all that, that gave you obviously an insight into business. Is that where the accounting streak came from? You knew like you needed to understand numbers to then interpret how investing works?
Yeah, so I mean, I was naturally good at numbers at school. So I remember in primary school, I used to go up a grade by myself and do their maths. And funnily enough, it actually turned out to be a falsehood, because as high school went on and it got harder and harder, at some point I just thought I was going to naturally be able to do it. And then I realized in year 12, where I only did maths once, so not the super hard maths. And I realized with a week before the exam that I actually didn't know what I was doing, and rushed to the teacher and said, I stuffed it. I just haven't done the work. And so that was where maths got me. But I did always understand the numbers. And to me, the accounting thing was just more practical than anything. I grew up in Mount Gambier, which had 25,000 people. And there's no real white collar jobs there. There's a few insurance agents, and there's a couple of accounting jobs. And it just seemed, I didn't actually get into accounting. I picked accounting at Adelaide Uni, and didn't quite get the score. So I ended up picking just a low thing at Flinders University, and the lowest thing that had anything to do with money was economics. And I could have actually done better in terms of getting into a higher ranked course, but I got into my safeguard and ended up at Flinders Uni on my own, where all my mates were at Adelaide Uni. And I actually enjoyed that a lot more than accounting, but I got finished the 3 years, and got accepted to do honours, and I really didn't want to do it. I didn't actually think it was going to be very practical, but I got offered a job back in Mount Gambier, and I could go back and play footy for my old team and get a bit of extra money. And so my plan was to take the graduate accounting job at Carter Holt Harvey and just learn a little bit about business. And Buffett, not that I knew he said it at the time, but he was always said it was accounting was the language of business, and you need to understand that stuff. And I thought that would be a great entree into becoming an investor and an analyst. Turns out it sort of is, but that sort of old method of going from accounting to investing is broken down, I think. So that sort of wasn't there by the time I was old enough and mature enough with enough experience to make that move. But that's where it really came from. I was really just trying to get a job, and talking about a kid who come from a trust home, earning $25,000 in your first year of uni was actually sounded pretty good.
Bloody oath. Here's a question for you, Nathan. If you were to do it again, would you go back and, if you wanted to be an investor today, young Nathan, would you say to him, go and study accounting, go and study economics? Like, what would you say?
Yeah, no, definitely the opposite. I'd just say there's so many books out there now, but just go and read 3 or 4 of the classics. So you don't even have to read any more than that. The Peter Lynch books. Go and read all the Buffett letters. I still think they're the single best, ornament to investing and business. Just understanding a return on capital and how businesses can invest, and they can choose to invest or repay the money to shareholders, and what avenues they've actually got to invest, and why is it that some companies end up leveraging up the balance sheet and buying a stupid business that makes no sense, and then having to have another CEO come in and fix it up, and then they get paid twice as much as they should just to get the best business back to where it was before. Like, just understanding those things is huge, and the earlier you can understand those things. But the things that really helped, and we talked about superpowers early on, and funny enough, I actually made a little list here. I might actually just read a few of them.
Yeah, sure. Do it.
I think these are the things you need to learn that you won't find necessarily in textbooks. But if you're looking, I think these days there's enough of these books around about psychology and how it relates to investing, that just reading a couple of these books, these are the superpowers of investing. And like just being able to think long term, independently, to own your own mistakes in investing, which I still see adults who just refuse to acknowledge their own mistakes. But when a stock goes up, they take all the credit. All right? You're never going to be a good investor by living that way, or in life for that matter. To be bold and back your own analysis is huge. And I could tell you multiple stories of missing Domino's at $3 because Steve walked past me and said, "Look at these idiots thinking they're going to be able to sell pizzas to the Italians." And I was pretty green, and I was going to take this to our Dragon's Den. And that $3, like that $3 stock went to $160 last year. And I didn't buy it because this superior in the business, who I was going to have to convince in the Dragon's Den, said they were idiots. And I thought, well, he must know better than I do, so I'm not going to buy it. So, being in an environment around other professionals, you look at them and you're very biased by them. So you've got to have the courage of your convictions. And I think that's a huge one to have. I can talk about other stocks as well, but to avoid the crowd, and even just a couple of little things I'll put on here, like these are superpowers, not for business necessarily, but just for life. But to be able to apologize and having a sense of justice and not be greedy. I just think the older I've got, the more I realize how important they are to not in business and investing, with your staff. Like as a fund manager, I'm managing staff expectations, client expectations, members in a subscription business, management expectations, investors in our business, InvestSmart, which is also a listed business, our board, the ASX, whose listing rules we have to abide by and whose liquidity rules are applied to our portfolios. So there's all these groups of people that you've got to manage the expectations for. And I think those other skills, the earlier you can learn those and grow up as an adult, and I wish a lot of those things in psychology, in ancient philosophy, I wish I knew more about those things when I was a teenager. And, I sort of had some emotional issues with my parents' divorce and those sort of things. And I had a bit of a wake up when I was 25 years old and realized I couldn't, keep reacting to things with just anger and frustration and not talking to people and things like that. And you talk about being a CEO of a business and a position of responsibility now. Like, I couldn't have been that person at 25, even though I was captain of sports sides a lot, but that was more from ability than anything else. But if you can learn all those types of things, which aren't just about hardcore numbers, like, you're an attribute no matter what business you're in.
Right, that's a wow. I don't even know where to begin to unpack that, but I guess first thing is like thanks for sharing. Like a lot of those details are personal, and I can relate to a lot of them. To be honest, in fact, like I'm just imagining myself as you're explaining them. And yeah, I think to be honest, I was saying recently, I was actually to Evan Lucas of all people, that the ability for introspection is like it's a superpower in itself. The ability to look in on yourself and study yourself is just so powerful. And it took me, I'm 31 now, Nathan, and it took me till 31 to figure that out. And I wish I learned it earlier on, because not only would my investing be better, that would be like a a micro part of it, but my life would be better, right? And so I'd understand the world better. And yeah, I can relate to so much of what you're saying there.
I think the other one, just the sort of icing on the cake for that stuff, which I've learned more recently, is forgiving yourself. I think we're just so hard on ourselves, and we put such huge expectations on ourselves. And I talked about how my dad was a sports star in a way. As I said, he played state football for cricket. And my dad never put that pressure on me, but you carry that around, especially in a small town. So everyone expects you to be a good football player, and I was, but I went to Glenelg and never quite made it. I wasn't big enough and didn't put enough into it. But the same with investing in a stock. I just think I've seen the vitriol that comes out these days, and I think part of it's driven by social media. That when you get a stock wrong, it's just the vitriol that comes on us these days is far worse than ever than it used to be. And you've got to be able to forgive yourself, but I think also you've got to be able to forgive other people as well. And I think that's a really monumental thing to be able to do in life. And I've had to deal with friends who have suicided in recent years, and they left behind a lot of blame for other people to carry around, and they're trying to work through the process of what they did wrong. And the last point of it was actually just to forgive themselves, because they didn't actually do anything wrong. It's just a difficult situation. But I think in business, we've got to be able to be bold and make mistakes. And I think this is why the American economy is still the best in the world, because people respect people who build businesses and fail. And obviously there's some nasty failures where they've done the wrong thing, but that entrepreneurialism is something I think is still lacking in Australia. We need to encourage more, rather than encourage people to flip homes where they're making so much money, but doesn't really add any value to society or to the world. Whereas building a business really does. It hires people, and I've seen a number of people who have retired early because of their investing deeds, and then spiral into depression because they've got nothing sort of left. They're just sitting at home doing nothing. They've got no social interaction. They've got no challenges to outperform or to find the next stock or whatever it is. And I think we're going to talk about what would you do with a lot of money, but I've just seen the best and worst of money, and mostly the worst. And funny enough, all I wanted to be was financially independent. That's all I've strived for, and should have happened earlier. But funny enough, now that I've got here, I thought I would have quit straight away. And yet, seeing what other people have gone through, I've seen that quitting is not necessarily the answer. Particularly in Intelligent Investor, where it's taken a while to get the place going, and the team's been together. We've been together for at least 10 years, some of us, and 15 or 16 years for others, and they're valued friends as much as they are, part of the team and staff. And so, InvestSmart went through a tough time through the GFC, through the COVID bust, and now finally everyone's happier. The business is going well, so I don't want to walk away from that. But I'm also just learning more about human behavior and what people have gone through. And you've got to really have something driving you, because I think Alzheimer's is the other thing where this falls off, is people retiring in their 50s and got nothing to do. So they sit down and watch the tennis on TV, and, maybe just be unrelated, but they end up dying early of Alzheimer's. And so we've got to find these challenges, and money's not the answer to everything.
Yeah, I love it.
Sorry, mate, bit deep for a Friday afternoon.
No, it's probably the best time for it, right? Then we can just take this into the weekend and let it soak in. Yeah, I got to say, like the tall poppy syndrome that we have here in Australia, from an entrepreneurial perspective, is unfortunate in that we look at people and we're pretty quick to shoot them down. I guess, a natural human tendency in a way, and jealousy and all those envy things that come in. But also, I do look at the capitalistic nature of the US, and while I wouldn't be the person that looks at the rich list and says they're the most successful. Some people will say the most successful because they're wealthy. I don't necessarily buy into that, but I do buy into the idea of taking risk and being proud whether you succeed or you fail. I think that innovation is what drives society. And I think the reason that businesses exist in the first instance is because they create value, right? There's a cost and there's value created above that cost. And that is what adds value back into the economy and keeps things moving forward. Does that make sense?
Yeah, and I think one of the worst things that's come out of this zero interest rate um, era, if you like, or just episode, is that really the normal rules for business investing didn't apply anymore. And basically there was just so much money going around, people could do anything. And it is funny, it's sort of two sides to it. There's sometimes you need that free and easy money in the good times to actually start businesses. A bit like a fund manager, if you want to raise money, the best time is at the
Mm.
peak of the bull market when you've got the least ideas. But if you go out there with a portfolio of great ideas at the bottom of a bear market, no one will give you any money. So some good things can come out of that. But normally what you see when you've got an interest rate so low, where there's just free and easy money and no penalty, and essentially the hurdles for business success are so low, and the money being invested is so frivolous that you get things like all these Bitcoin and the the derivatives.
Yeah.
I mean, we haven't really established that many processes for valuable processes for Bitcoin anyway. But all the derivatives, I think about how much money has been blown up in that for no other reason than speculation. And I think that's the problem with the zero interest rates, at least one of the major ones anyway, is that it stops people thinking about proper business and proper returns and doing something useful, and turns into just a waste of money. And I actually think there's been this enormous opportunity lost around the world, but particularly in Australia and America and Europe, to a lesser degree. But we could have invested in green energy or building more hospitals or schools or whatever, because we could borrow at nothing.
Mm.
And we didn't do that. We just threw money at people and not completely wasted it, because obviously that was some people's income and it's all they had. But we could have just improved productivity out of sight and done some really useful long-term investments for the next 20 years. And no one did that. It's not a popular thing to do. It doesn't win your votes. But that's why you're supposed to have politicians and leaders that can stand up and tell you and explain why we need these things and why they're worth doing. And unfortunately, politics is just such a horrible place to be at the moment. And popular politics means a lot of these important things aren't getting done. So
Mm.
I don't like the environment we're in. I don't like the way the stock market these days seems to be more of a casino than it's ever been. I think it feels like it's more important than actually building businesses. So it's actually, I don't actually mind seeing is it Mike Cannon Brooks and these people actually getting involved in some business and putting some of their huge fortunes into something more useful for society.
Do you think, Nathan, that, you know, as we roll out of QE, or maybe fall out of it, do you think though that we will see, so the dust settles and those mediocre businesses, the ideas, the concepts, whatever, they fall to their knees and maybe they go out of business. But do you think then it emboldens those that were built on like legitimate foundations?
Yeah, it's an interesting one. I think if I look at, I don't know if this quite answers the question, but I'd say one of the real, I guess, disappointments is when you hear terms like fintech or new fintech, and you
Mm.
actually have a look at what these businesses are actually doing. And buy now, pay later. I mean, seriously, has there ever been a bigger waste of money? And I hear people still, even though the more these businesses lend, the more money they lose. I've heard good fund managers still talking up the management of that business, and I just think it's disgraceful. But I see a lot of the new fintech is just really online avenues for existing business that they're just taking off the banks. So are they creating anything new and wonderful for the world? Well, not really. It's just a quicker way to get a loan with more risk. So I think that's what the disappointing thing is, and a lot of these businesses will actually survive and do okay. But funny enough, the big banks are actually in the best position to pick these businesses off, because to lend money, you need a huge balance sheet. And what all of these fintechs are discovering right now is that they don't have the balance sheets to continue borrowing money through the RMBS market, or the banks won't continue to give them loans. So there's a limit to how much money they can lend, but there's also a limit to how much money people can borrow. And if people aren't maxed out at the moment with their mortgage rates about to go up about 35% over the next 18 months, I really don't know how well these businesses are going to do, but some of them are trading surprisingly cheap. But it's interesting. I think my key point is what's seen as innovation is really not innovation at all. And I think a lot of these companies that are called tech stocks really don't deserve that name at all.
I like it. So, mate, let's pick up your story again. I'd love to. You mentioned the move from accounting then through to Investmart, Intelligent Investor. Can you take us through that period and what you were working on and how it came to be that you worked for the business?
Yeah, so basically, I was an accountant. I went to London for a couple of years, just on the old holiday visa, and I did that because I was actually more afraid of moving to Sydney on my own, because London seemed to have this whole structure for Antipodeans to work, and I wanted to go and have a look at the world, and went to Russia and a few different places, and so I did that for 2 years, and I actually ended up depressed because sort of fell out with my dad through that period, and you're away from all your mates. And then the second year, there was no spring. So remember, when you go to work in London, like all day, like it's dark when you go to work and it's dark when you walk out of the office. So it's really depressing. So you really wait for spring to come. So spring never came the second year, and summer was like barely a spring at all. So it was really horrible weather, and it really does mess with you. So I got pretty down, left depressed, come home, moved to Sydney, where a mate who has become a very good barrister in Sydney. And so my first job was accounting, which I just hated, but I knew that's all I was going to get a job doing. And I just kept sending in my CVs while I was doing, I did the Fincher course, the graduate applied finance, whatever it's called. And then that's Kaplan these days. And I finished that while I was in London. And so then I'd send my CV, and people, when I got back to Australia, people would say, "Oh, no, you don't need that. You need this CFA." I was like, "Oh, it took me forever to finish this thing." And I almost did like 2 streams. I did like the regular analyst one, and then I did all the financial planning one as well, bar one subject, when I finished my CFA and got my job at II, and said, I just can't do it. I've never, flunked anything in my life, but or completed anything. I just couldn't do it. So I had my job at Deutsche Bank, and I had that for maybe 2 or 3 years, just doing a different accounting. It's not interesting. And I basically just gave up. I was 30 years old. I'd done my CFA by that stage. I failed 2 levels, which was really frustrating. The second level, I thought I might fail. I wasn't confident. I must have only just failed. But the third level, I didn't expect to fail. And when you fail one of those levels, you've got to wait 12 months to do it again. And here was me thinking that my whole future opportunity to work as an investment analyst relied on me having this meal ticket. So I was really angry about that, because I'd done a lot of work, and it just, for whatever reason, I just didn't get there. Anyway, I sorted out the next year, and that was basically the exact same time that I got my job at Intelligent Investor. And it's funny, it wasn't my analysis, I don't even think, got me the job. I think it was more that I wrote an article with a couple of jokes in it, and because it had a little bit of personality in it, and I think there was some clear, obviously, that I had a financial background, probably got me over the line. But when I got in there, I actually feel like my boss said this to me, like, I understood the basics of investing well straight up. My writing was terrible, and that was part of the reason I got sacked. But like, writing's hard. You think learning to be an investor is hard. Like, writing is just another. Like, it took me 5 years to be just half decent at it. I still don't think I'm very good at it, and particularly against the guys I work with. But once I got in there, I actually felt like I was picking the right stocks. If I look back, the worst thing that happened through that period was the culture of the time was esoteric stocks, like really finding, I don't know if you've ever talked to Steve at Forager, but the way he invests is that real cigar butt type stuff. And that was really the stuff that was rewarded in the business. And I just think that's really, really hard way to invest. And it wasn't personally the way I invested, but it kept pushing you into that direction to buy these really low quality stocks, hoping you're going to make double your money or triple your money, because it was trading at such a low valuation. And then, Timbercorp went broke, and we were all up and down the credit structure as well as the equities. Then the other one that was similar, Green, whatever the other timber company was, that went broke. And I actually attended I call it the wake in Melbourne, because I'd moved down to Melbourne at this stage because Greg had sacked me, and I was thinking I was going to lose my job. And I went along and there was, I don't know, there's probably 300 people in this auditorium, and I think it was a special meeting that was called, and they hadn't officially gone. Great Southern, sorry, was the other one,
Mm-hmm.
and they hadn't officially gone bankrupt yet. But I was sitting there with no money on the line, listening to some people. One person put $8 million into the credit securities and
What?
the ordinary shares, and this thing was worth zero. So that was so this was the path we'd sort of gone down as a business, and it all blew up in the GFC. It's not that we didn't upgrade Cochlears of the world and some things like that, but I really missed a big opportunity personally, because when the GFC came, I upgraded a bunch of stocks like Nanosonics, which ended up being a 10-bagger,
Mm.
CSL, which I remember upgrading at like $32 and thinking, geez, I hope if this goes well, it could get to $40 in the next couple of years. It went to $330 over the next decade. Never owned a share. Domino's I passed on because, as I told you, the Steve story. And I upgraded a bunch of great stocks, and a lot of members would have done really well following those stocks. But I was sort of stuck in this no man's land of trying to buy this cheap stuff,
Mm.
and I did okay, but like nothing compared to the 10 and 20 times amount of money you made on buying these great businesses at good prices. It was that simple, and it wasn't like I wasn't aware of them. I was telling other people to buy them. I just didn't
Yeah.
buy them myself because I thought it was too easy. It's like investing can't be this easy, and I think that's the real lesson I've tried to carry around to the team these days: is let's not make it harder than it needs to be. And that's what professional investing really does to you. It tries to put you in a box. And if I just give you a couple of examples, we've got 3 funds where we've got an income fund, a growth fund, and an ethical fund. Because they're ASX listed ETFs, they all have very strict liquidity requirements on them. So you can't just go and buy all your favorite small cap stocks.
Mm.
They're all cap funds. You've got a very small amount of those you can buy. And if they don't get you on the market cap size, they get you on the number of shares traded. So we even own Infratil, which is like a $6 billion business, infrastructure business. It's worked out great. But because the ASX shares, it's a New Zealand-based company, because the
Mm.
ASX, like not many shares trade, it gets caught in our liquidity bucket. So now you've got share prices falling and more shares falling into the small cap bucket. Now I'm selling businesses I really like just because they're falling into that small cap bucket. And this is without any redemptions or anything like that. And I remember there was another small cap fund which owned this Altium.
Mm.
I watched them own this and talk about this company from like $2, and it got up to $8. And I think maybe it was $1 billion business at that stage. And they loved this business. They knew it inside out. It was everything they wanted. And I'm pretty sure the guys invested in personally and made a fortune. But the thing is, when you own those great businesses, what's the worst thing that possibly you could do in the world is sell it. Like, you've got to crystallize capital gains. You got to go and find something else to invest in that you don't know as well, or it's nowhere near as good a company. And the only reason they had to sell it was because they're a small cap company. Now, that just makes absolutely no sense, no
Mm.
common sense whatsoever, other than you're a small cap manager and you've told the market that you're a small cap manager, and therefore at $1 billion, you're going to have to sell these companies. That's just the stupidest way to invest I can imagine. So you learn these things as you go along. And I sit here now as a 46-year-old, and those 3 years I spent at Peters McGregor at the International Fund, I remember probably a month or two in, and I won't go into too much detail about my experience there, but I realized I was actually a better investor than what I'd give myself credit for at that point. One of the reasons I took that job was because I wanted to go out. Intelligent Investor was the only investing organization I'd ever worked in, and I just
Mm.
wanted to see whether our processes were as good, or Peters McGregor been around for 20 odd years with a good track record. What did these guys do differently? And I realized that it wasn't anything different. We had a good process at Intelligent Investor, and I realized I was a better investor than I gave myself credit for. And that gave me a lot of confidence that from then on, whenever I got my next role or whatever, that I was capable of a lot more than I'd already done. And the returns when I was managing the model portfolios in Intelligent Investor were very good,
Mm.
but it was a very good period to be investing as well, sort of 2011 to 2015, coming out of the GFC. But I just believed in myself a lot more then. So when the time came and I came back to Intelligent Investor, I had a very clear idea of the companies I wanted to own. And I think that's the beauty of the Australian market, is when you do global, it's just never ending.
Mm.
There's always 50 more stocks to look at, and you end up sort of just paralysis of analysis. I think there's just too much to choose from, and there's never any work. Plus the hours are different. Plus there's quarterly reporting, and there's always another 50 stocks in another country you don't know about. So go and spend some time on them. But But to me, I've just, because of that experience of watching the CSLs, the Dominoes and Nanosonics, and you didn't have to take big risks to make huge amounts of money, but the earlier you can find those businesses, the better. And so that's really what I try to drive at Intelligent Investor is keep it simple, find the stocks we like, keep an eye on valuation, stick to the quality, but let's try and find 2 or 3 new big winners every year. And whether that's an Audinate or a Frontier Digital Ventures or an RPM Global, which I think are probably the cream, or an MA Financial, probably the cream of what I think are the safe, more reliable small cap stocks, or saying that about Frontier is probably a stretch at the moment. But they're the sort of business can make an enormous difference to your portfolio. And then this year we bought coal stocks, or 2 years ago we bought coal stocks, and obviously we didn't expect Whitehaven to go to $10, but occasionally you just get these incredible bargains. And again, when we first upgraded it, Gaurav said buy at $1 and sell at $3, and I thought, oh well, I can probably buy other stocks that can do better than that. Now we've got this downturn coming, there'll be business that can go up 10 times. Well, take the opportunity while it's in front of you, because it's probably the lesson, because him and another friend of ours have made millions out of this, and it just goes to show you never get them all right. You're going to miss things, and you got to live with that. But I just think investing is always a challenge. But as soon as you try to complicate it, or again try to get blood out of a stone by taking on margin loans or putting too much in that risky thing, it catches up with you pretty quickly.
So obviously there's so many things we could pull on there, but one of the things is obviously Australia being a smaller pond for you to fish in. And you said, 2 or 3 new ideas a year is, great. How do you go about, like, I guess in the initial sense, Nathan, just for folks that are kind of new to Intelligent Investor, how do you go about, like, what are the characteristics of businesses that typically end up in the portfolio? Do you have like screening filters or anything like that or metrics that you look at as like a rule of thumb?
Yeah, look, there's a lot of that stuff I probably just do in my head, or I just know that I don't think about on a daily basis. But I think this is probably the one thing, if I could just tell people, I wish someone had told me early, is just if you've got money early on, just buy the best business you can find and don't worry about the rest. Just buy the best business, and the more you save, put more into it. Or if you want to diversify a bit more as you get a bit more money together, buy the second best business or the third, but don't go buying the 20th best or whatever. Those great, rare compounding businesses, just focus on them and nothing else. And that's the advice that Charlie Munger gives to everyone. Basically, he's only owned 2 stocks: is Berkshire Hathaway and Costco. And Costco, depending on how you look at it, is arguably the greatest retailer ever, or certainly one of them anyway. And it's just that compounding over time that just creates the magic. So the question then is from people, okay, well, how do you find the best business? And it's actually pretty easy. I say it's easy now, but obviously when you're starting out from nothing, it's just trying to work out what's good business is difficult. But there are a couple of attributes. One, it sounds so blindingly obvious, but just buy the best business in the best industry and buy the market leader. Very occasionally, buying the second best in an industry can work out. Like Fish and Paykel Healthcare is sort of the third operator against ResMed and Respironics for sleep apnea products. So it's very, very good business. That's a rare one though. It's very rare that the second and third player are anywhere near as good as the first player. But be prepared to pay a premium for these businesses, and that's where a lot of people go wrong, trying to buy statistically cheap stuff. But these businesses trade at a premium for a reason, and the reason is what you want is a company that doesn't pay dividends but has so many investment opportunities in front of it that they're going to earn high returns on when they reinvest that money, and can keep doing that for long periods. And that's essentially what the definition of compounding is. And so this is what I think the magic of CSL is. And Brian McNamee, who was the CEO there, and I thought this is sort of the magic and the difficulty of CSL as well, is over the years, like I've heard from lots of people who own shares from 1992 that they bought it like it was $1 or $2 or whatever it was. There's no way in the world anyone, and even anyone who worked in that business, knew what CSL was going to become. Even 10 or 15 years ago, you didn't know what it was going to become today. It's just got better and better and better. And as time gone on, the business has got better and the competitors have gone away, certainly less of them. So, there's a lot of luck involved in investing, but that to me highlights that it's not obvious always. The great businesses aren't obvious, But the ones that are great, just they invest for the long term. They're patient. They're not doing risky acquisitions. They're not doing debt-fueled acquisitions. They're not trying to force anything. They're just staying within their financial means, but they are investing for the future, and they're prepared to wear financial pain in the short term to make those investments. And I think that's where the magic is in CSL, because a lot of the investments they make are like for 10 years ahead, and they have no guarantee of whether those investments are going to pay off. And that's really the magic, because there's an article I read a long time ago where Brian McNamee said, it's actually his chief scientist, who I think might have been, his last name was Fraser, said, he's the magic person. He's the one deciding how much money I need and what investments I'm going to make, not knowing what the payoff is in 10 years. Whereas that's very different to, let's say, Coca-Cola, which is famous because Buffett made so much money out of it, where they've got this incredible distribution network all around the world. And all they have to do is just keep expanding the network and keep increasing their marketing. So that's much more predictable than CSL. So, and CSL share price went nowhere for 5 years. So again, it just shows incredible patience to be able to hold through that period. Because, I actually tell people, I couldn't have done that. Yet, funnily enough, Frontier's share price is almost back to where I bought it 6 years ago. And I think it's a 20 times better business than it was when I bought it, but the share price isn't saying that.
How many of these great businesses do you think are currently available on the ASX? So even if you don't own them necessarily, like how many roughly would you think that they are out of the 2,200 stocks or whatever we have?
Yeah, my guess is 12 to 15.
Yeah.
That's it. There's no more than that.
Yeah, right. And so I feel like if there's only 12 to 15, I feel like you've almost got to own them, right? Like once you find them, you've got to stay with them.
It's so it's so hard, and I sit here, and a bit of a mentor for mine, and a great read if anyone wants to read quarterlies. They're by far the best quarterlies ever written. Is Tony Shenner at Selector Funds Management. They're getting pretty long these days, so people won't have the patience to go with them. But they are for the Australian market. These are the Buffett letters. They're incredible writings, just in terms of the detail. And basically, he owns a portfolio of the best. And I try, like I have my little Tony Shenner on one shoulder when CSL gets a bit expensive, or whatever it is, and I still have that bit of the value, the value investor, I think, mentality of valuation matters. And I struggle to hold on to really expensive things, because I'm always backing our team, which is 5 people, to find another idea. And so that's a bit different to personal investing, where a mate of mine whose dad, I think, was the #1 waste management guy in New South Wales, and sold his business. I don't know whether it was Veolia, or he sold his business to Veolia. And so he buys stocks and refers to them as collectibles. So he buys like ARB, the 4-wheel drive company, parts and accessories, and he collects them. So he has no intention of selling them. And that business hardly grew for about 8 years. And then all of a sudden, during the COVID bust, earnings double, and it signs up all these new agreements with Ford in America and all sorts of things. And it's just that there's something in that patience. You do get rewarded, but you don't get rewarded all the time. And that's what makes investing really hard, but particularly as a professional, because it's crazy. Here we are trying to put portfolios together for the next 5 to 10 years, and we get measured every 4 weeks. And if you don't measure up, you need to explain yourself. And that's really difficult. And I always remember the quote from Mike Tyson, of all people, who says everyone has a plan until they get punched in the face. And everyone's a long-term investor until something goes wrong, whether it's a bear market or whatever. And then everyone's just about, what have you done for me lately? And so we're really lucky at Intelligent Investor that we're not managing billions of dollars. We've got an investor base that understands what we do and has been with us for a long time. And they are generally long-term investors. I'm sure not everyone is, and I'm sure there's a whole bunch of them that are enjoying the ride we're giving them at the moment. But if you've got a client base like that, it just makes all the difference.
There's a business. So let's talk about, I don't know if this is one of those businesses that fits into the 12 to 15 you said before, but a business that you emailed me earlier on, which is MA Financial. Is that the business? I've never been into it.
Yeah. So this is the old Molus.
Oh, right. Okay. Yeah. Okay.
Green
Now I know.
Yep.
Yeah. Tell us a little bit about this business, Nathan, and I guess how you think about everything like this. I think this is just would be a really good illustration of your process and the way you apply these ideas and strategies for thinking and investing better.
So there's a great story by Charlie Munger, who read one of the financial magazines for 50 years. And,
Oh yeah.
and so through that 50 years, in 2001, he finally bought a stock from all the recommendations after 50 years. And I think he turned something like $10 million into $80 million. I think the company was Tenneco, which is an auto parts supplier, which looked like on the surface it was going broke. He didn't think so. And he bought a heap of shares and a heap of bonds as well, which are trading at like a third of par value. So it was like a 33% yield or something. And the business recovered. And so he turned his, I think it was like 10 million to 80 million. And then he took his $80 million and gave it to a guy, I think his name Li Lu, who's a Chinese investor. And Li Lu turned the $80 million into $600 million or something. So it's just, how do you find ideas? Well, he read the magazine for 50 years and finally found one. So, you just keep reading things. You don't know where the idea is going to come from. But I always read small cap managers because reports, the ones that I respect, because they occasionally find a small cap I haven't heard of yet. And this one fund manager owned this, what was called Moelis. And I think it listed in 2017. So it was a fairly new company as far as the ASX listing was concerned. And I just listened to it, learned a bit about it, and it ticked all the boxes. And it wasn't cheap enough to buy. It was pretty small. But then we got COVID, and the share price just collapsed. And it didn't make any sense to me. It had no financial problems whatsoever. It had the background to the company was there's an article you can read, old article in the Fin Review, which is really illuminating. A guy called Andrew Pridham, who was an investment banker, had met a guy called Ken Moelis in America. And Ken Moelis was actually somewhat famous for running a somewhat small investment bank. But I think he'd done some monstrous deal with a Saudi Arabian company. I think maybe he floated the Petrobras or whatever, that enormous company. It was like the biggest float ever in history. So I think that's what made his name. Anyway, Ken Moelis said, look, I want to back you and I'll start you up in Australia. So they started this business in 2009 called Moelis, where Ken Moelis, or the parent Moelis company, I think maybe had 40% of the shares or something. And Andrew Pridham, along with his two understudies, they own most of the rest of the shares. So they just sort of kept ticking away. Like, I'd never heard of them while they were a private company. But when COVID hit, I was aware of the stock. I was aware of the business, and the share price had gone out like $1.29. And I think I bought a few shares, but I didn't buy many because I was all in Frontier, which has gone nowhere. And Moelis ended up going up to $10. So, talk about frustrating. So it was quite illiquid. Couldn't buy it for the funds. I tried, but it was just too illiquid. But the things I really liked about the business was, here were these guys who the founders who were in charge. There was actually like almost dual management. There's dual management today where the two CEOs share the role, which is quite unique. I'm always interested in when people are doing something unique, because it just says they're thinking about things differently. Sometimes it might just be clear they're doing something dumb or greedy or something. But this just sounded really sensible, where he had this sort of top dog training up his two youngsters. And so they're very experienced now. And basically what the business is a mini Macquarie. And so everybody knows Macquarie, and everyone sits there and goes, geez, I wish I'd bought Macquarie in 1990. Well, here you are. Here's COVID bust. Here's Macquarie in 1990. Same type of business in the sense that it's an investment bank. Recently, they made $37 million out of representing James Packer through this recent ordeal with Crown Casino alone. So obviously that helps. But they do other stuff. I won't go into all the different bits and pieces, but essentially it's a little investment bank or a boutique fund manager with this growing funds management business on top of the sort of investment bank services. And so that's a really nice place to be in. We've seen overseas that one thing I think really helps people is to look at what other businesses have worked well in the world. And if you look at some of the biggest businesses in the world that have done incredibly well and continue to do incredibly well, is Brookfield in Canada, AKR, Apollo. These are massive, massive fund managers with just billions of locked-in revenue. And Macquarie basically took that path during the GFC, when people might remember they had the old Macquarie Countrywide and all those highly leveraged satellite businesses that were just ripping people off basically, and leveraged to the hilt. So when that model busts, they turned into funds management, which was perfect because assets were really cheap, and now they're essentially a fund manager rather than the investment banker. And the beauty of that model is it's scalable. Like you can just continue to get big and grow even when you're already a very large size. So that's essentially, I had the insider ownership, which is really, really important to me because it just gives you a lot more confidence. It doesn't mean you just got to buy every stock with an inside owner running the business. As anyone who's owned Harvey Norman for the last 15 years will tell you, that share price has gone nowhere. And Jerry has perhaps probably harmed that business as much as he's helped it. But it's something I really look for when you find, the ARBs, even CSL, like it wasn't inside owner. Like Brian McNamee used to sell all his options when they came due every year, which always surprised me. But he managed that business like he owned it, which is quite unique. So that insider ownership really matters to me because you want these people with their own money on the line because they think long term. They create balance sheets where they can't be taken over, and they don't manage the balance sheet for the maximum profits today because that's a risk when you go into a recession that you go out of business. So that is, and you can see it, you can read it, you can just, if you follow them for long enough, you can just tell in the language how they're building these businesses. They're really patient, and essentially they invest in their businesses the way we invest our clients' capital, is just patiently for the long term. And there aren't many of these businesses around, but interestingly enough, if you think about it, most small cap stocks have to have the founder in charge because that's how they list the business to start with. So it actually gives you a really good head start, particularly over professional managers, because there aren't all that many small cap managers around. A lot of them have gone out of business recently, particularly through recession. Small cap managers, they go out the side door quicker than you can blink. And there's even less value investors around now too than what there's ever been. So you've got this part of the market that's, I wouldn't say unexplored, but certainly there's less exploration going on than what there has been historically. So you can find the next MA Financial or the RPM Global or Frontier Digital. Like the thing that these companies have in common is that they're business models that we understand. They're business models that we think can scale. So scale is just a fancy word for saying they can continue to grow at high rates as they get bigger. And they get more profitable because the costs don't expand as quickly as the revenue does. So that's really important, particularly for a software business. Or the ultimate in scale is like a fund manager who you don't need an extra analyst to bring in to manage an extra dollar of revenue. Every extra dollar of revenue goes straight to the bottom line. So we refer to that as operating leverage. You could have bought Magellan at, I think it was like 50 cents during the GFC, to go to $100 or something. So, again, another founder-led business. So, the characteristics are very simple: healthy balance sheet, profitable business in proven business models run by founders with their own wealth on the line. And that's basically it. And everything off of that, the three pegs really are just valuation, quality of business, and quality of management. There's nothing new in investing. There hasn't been anything new in investing in 100 years. Buffett and everyone else had this stuff figured out 100 years ago. The only thing that's new with every cycle is the participants. And they're the people we want to take advantage of because people are still as short-term as ever, still greedy as ever, and still want to get something for nothing, and that will never change.
Yeah, well, yeah. Yeah, I love the Jason Zweig line that he's paid an annual salary to say the same thing 200 different ways a year. One of the pegs there was management. Do you ever meet with management?
I'm not a big fan of it. If you're a rated fund, you'll never get rated unless you go and tell them that I'm spending every week going to meet all these management teams. The reason I don't like it is because they can't tell you anything that isn't publicly available anyway. What I think where it is actually really important is with the small caps. You can actually go and learn a lot about the business because it's potentially a new business in a new industry you don't know anything about. But I don't need to go and meet with the CEO of a casino company to know what's going on in there. It's on the front page of the news for a start. but it's a very simple business to begin with, and I've been doing this for 3 decades now. So I don't need to meet with the CEO. I can tell from their actions and what they're saying, what's going on. But it can be useful, and it's finding those new companies. But there's so much, like you're not at a disadvantage not being able to talk to management, and you can actually get the commentary from the updates usually somewhere online. Particularly I know you definitely can with the international stuff. So, but again, if you keep things simple, there's only so much you need to know. And it's funny, like I remember Buffett and Munger shared this story about how they went and met a manager, and they were so freaked out by this guy they just couldn't put $1 into this stock, and the stock went up like tenfold. And because my wife has worked at Baby Bunting, and I've seen how the staff get treated in there, like there's no way I could invest in that business, yet it's probably an all right business. So like there's all these strange things that investing about your own biases and, but I'm sure people probably look inside InvestSmart some days and go, what's going on in here? And you look on the outside and it's just a boring fund manager doing pretty boring things. But it just all depends on your point of view. But I don't value meeting management. I think how a lot of people do. I think valuation matters a million times more than that. Understanding the business is crucial. And if you need to understand the business, you're probably going to get a quicker phone call from the CFO anyway. And personally, I'd much rather my CEO was working than fielding calls from fund managers like me. Last thing I want him in the world to be doing is focused on marketing the share price.
I was telling you before that I went and saw a company down here south of Sydney today. It's going to be on the podcast soon. And this is like a traditional manufacturing business. And I said to the CEO, it's 100 mil market cap, so it's a small company, right? And I said to the CEO, how many people do you get coming through a year? And he's like, oh, maybe one or two. And I'm like, oh, what about, funds and whatever? He's like, oh, they might, maybe every now and again we have like a call. And I was thinking, this is like the frontier of these small caps. Like no one really understands what's going on because no one's bothered to go and have a look. And that's where I get value from it because I'm learning about a business in a new industry. But I would say overall, I've probably been sold more than I have learned from those experiences, if that's fair to say. I've got a question, like a bit of a primed question, Nathan, which is then, you've been doing this a long time. Who is one of the better capital allocators from a management team perspective that you've come across?
Look, I think CSL, which I already talked about, is the best I've seen, and I think just because of the difficulty, one of the greatest stories I ever heard was I talk about trying to find something unique. So Brian McNamee had testicular cancer and was laying in bed getting treated, but at the same time he had made a bid for a company which started with a T. I can't actually think what it was called, Teletrix or something like that. Anyway, this would have really consolidated CSL's position in the US. And he raised, I think it was like $2 billion or whatever it was from shareholders to make the acquisition, which was rare anyway, right? Because you don't normally see that. Normally you see a company just goes and borrows a crap load of money and makes this aggressive acquisition, and maybe there's a share raising to go with it, but it's not normally how things are done. And that to me was unique in itself, because buying with equity and buying with your own equity is a safe way to do it, right? Because if it doesn't work out, you don't blow up your business. Whereas you take on the debt, you are risking blowing up, whatever good business you've got underneath. Or maybe it's a bad business, but who knows? It's a sort of doubly bad business that's going worse. And so that was unique in itself. But then the US government or the regulator said, look, no, we're not going to let you buy this business because your market power would just be too much. And so he said, okay, so what you normally see in these situations is the CEO of the business goes, oh, you know what? Yeah, because, the CEO is always trying to make the business bigger so they can get paid better and like they can get their rewards and their bonuses. So that's always happening. So that's the difference between the founder and what I call the commercial CEO mentality. And so he said, okay, look, this is shareholders' money. We're not going to keep this money. It's not ours. They gave us this money for the acquisition. We're going to return it. And so he said, we're going to return it through a share buyback. And so that's what he did. And there was also part of that story. So remember, this is going on while he's in bed getting treated for cancer. He said a lot of other CEOs would be very stubborn. They've been told no, and then they'd go and fight it in the courts because he really wanted it. It was a valuable acquisition. And so he didn't do that. He was actually pragmatic and said, you know what, it's fine. Let's not go and battle this. Let's give the money back to shareholders and get on with our life. And, and CSL has probably gone up 8-fold since then. So to me, they're really unique characteristics of a capital allocator. Capital allocation is such a fancy word. I sort of hate the financial lingo that we use sometimes, but particularly when you're doing a podcast or a video for people who are trying to learn and you're using these words, like capital allocation is just how you spend the profits. But that's really important. And the reason it's important, because I think the statistic is something like over a decade, 70% of the value of the business comes from how those profits are spent. Let's let
I
that
haven't
sink
heard
in.
that. That's great.
Basically, all the value of the business over the next decade comes from how those profits are spent. Not making those profits, but how they're spent. So that capital allocation decision is absolutely crucial. And that sort of, comes back to that, sort of feeds back into that, finding businesses that can actually do something useful with that money. Because if there's nothing useful to do with it, they've got to return it to shareholders, which is fine. If they've got nothing useful to do with it, that's what you want. So essentially, that's what the banks do, right? They can't lend all their profits, so they pay back these dividends, and we get the franking credits, and that's fine. But then you find other more ambitious, risk-taking CEOs who just want to reinvest that money in just trying to make the business bigger for the sake of getting a bigger bonus, and they're the companies you've got to avoid at all costs. And usually you can tell because they call the acquisition as company transforming, so they're actually telling you to sell.
If you could go to dinner with one investor and one CEO, if you could get them both together at the same time, who would you go with?
I have no idea, even though you gave me an hour to think about it. But I'll tell you one story. It might be a bit more interesting. Is I can't actually think who wrote Poor Charlie's Almanac. Can you remember Peter Kaufman?
I'm going to Google it.
So we actually met him one day. So we went to California, and he has a little business just outside, or I guess it is LA, but it's sort of quite out of the CBD as such. And we went and sat with him for 4 hours and had lunch with him.
Huh.
So this guy, for people who don't know him, so Poor Charlie's Almanac is a very famous book. And if you don't know Charlie Munger, he's very quick-witted, but doesn't tolerate fools, is a nice way to put it.
Yeah.
And Peter's the same. Peter had met Charlie, and he actually put some questions to Charlie, and they ended up getting along, and they became friends. So it's a pretty hard thing to do, because it's hard to be friends with Charlie, because there's not many people he lets into his circle. He's just whip smart too. And so he wants to be mentally stimulated. So if you can't do that, he probably hasn't got any time for you. And sitting with Peter was one thing he told us, which was really interesting. And he said Berkshire had done deals with 3G, who you might remember, probably a decade or so ago. And he didn't really like the culture of 3G, whose culture was really to buy businesses, cut costs dramatically, improve the margin. So I guess a bit of a private equity type style of investing. Even though it's sort of funny to say investing when they're just ripping the guts out of these businesses and loading them up with debt, taking the cash out and then trying to punt these businesses onto some other poor sucker. And he really didn't like that. He thought that was really against Berkshire's culture. And I thought that was really interesting because, Buffett and Berkshire, no one has a better record than them. No one's done more for, I think, people, how they view business or investors or how to learn or anything. But it was interesting to sit there with someone who was friends with them and openly criticised them amongst us four. And he talked about, actually, if you wanted to get rich and earn a really good living, he said there's, look for these sort of small businesses. This is America, so small business was probably 500 million or $1 billion. And he actually add a lot of value that way. And he was perfectly happy with this seemingly little business, off the radar, living his life and just every day trying to get extra productivity out of his business. And we just don't sort of have, I think, that entrepreneurial flair, or I don't read much about it anyway. I'm sure we do have plenty of entrepreneurs, but it's sort of not the culture in Australia. I wouldn't have thought. I think you have to battle pretty hard to grow a business in Australia, and we tend to flip houses more than build businesses. But that was a really great opportunity to talk to someone who was much smarter than I was, and also just, enough was enough. Like, he didn't need to be a multi-billionaire. He just really enjoyed the process of business. He enjoyed the process of thinking and learning and looking after his staff. That's a great way to live. Like, we don't all need to have $100 million to live well or aspire to that. And I could talk about, I've seen the worst of money. So to find people that just are passionate about whatever it is they're doing, it wouldn't even, like, I don't have any names, but the people I'd like to be interested in are not even investors anymore. I started reading Reminiscence of a Stock Operator 2 days ago, and I think that's the first investing book I've picked up in 5 or 6 years or something. Because I don't really want to learn more about investing. I want to learn more about people and how they behave. And there's people doing a lot more interesting stuff than investing. Like, I feel like a robot these days. I know what's expected. I know what I have to do in certain situations, because you're just so well tuned after doing it for 30 years. So it sort of takes a little bit of the excitement out of it, but that's what happens when same with the guitar. You got to be careful, I think, after you get so good that you lose the feel and you just become robotic and you're not creating anything anymore. So in terms of investors and CEOs, I'll pass, mate. I'd rather have a beer with you.
Well, I look forward to that. But yeah, that's a cool story. Sitting down for 4 hours. It's funny how you can just lose time with some really great people when they give you the time. That's really special. So, you kind of mentioned, so you've touched on this a few times, Nathan, which was like earlier on you said you just wanted financial independence, and there you just talked about this guy that, you know, he's happy to run his own race and just do what he wants to do and kind of design his life. Um, so if you had a bucket load of money, right, you had a truckload of money, would you still do the same thing then?
Yeah, the interesting thing is, I became financially independent a little while ago, not that long ago, but enough to live off. We don't have a fancy house or anything like that, but my wife's earning a lot more money now than I ever thought she would, so that's just completely changed our lives. And we could live off her wage now because we have pretty minimal expenses, and your life tends to get a bit cheaper and less aside from our kids. You're not sort of going out and doing the fun things that you used to anymore. So funnily enough, your budget sort of shrinks a little bit in that respect, but it obviously gets taken up by your kids. But I enjoy what I do, and I think if you were asking me 5 years ago, I think I would have said I would have quit by now and just managed my own money. But it's taken a while to get intelligent investor. I've been in this business since 2006, and it's taken ages, a long time to get this business to something that's actually a lot more exciting and sustainable. And I think we're only just scratching the surface with our funds business. The returns are great. I really enjoy the people we work with. They're great people. And it seems a shame to walk out of that when it was just things are finally, after all these years, starting to go well. But I enjoy the people more than anything. That's what keeps me there. If those people weren't there, I wouldn't be there. But in terms of, I still enjoy the challenge of investing. It's the greatest drama in the world, probably other than politics, if you're into that. But in terms of actually doing anything different, I've got plenty of time to learn the guitar, and I go to the gym every couple of days, although I procrastinate for 2 hours before I do it. I get to hang out with the people I like, and I can't really ask for anything more than that. There's no other real big challenges out there, and managing my own money actually sounds pretty boring these days. I had all these plans. I was going to follow the Formula One season around the world, but you realise that we've kicked our eldest son out, but we've got twin 11-year-olds, and they need to go to school, so I can't go anywhere anyway. So I think for the next few years, the challenge is still there.
Yeah.
I enjoy investing, and at some point, I'd like to, as I've talked about before, elsewhere, just own my flash apartment looking over Bondi at some point. But $100 million is going to make no difference to me, and the research shows that once we're really earning about, I think it's like $50,000 a year in income, our increasing happiness is marginal at best. And as I said, I've seen the worst of money, and large amounts of money seem to cause more problems than opportunities for most people.
Yeah. The apartment looking over Bondi would be nice though. Yeah, I gotta admit, mate, there's a heap of ways that people can get involved with Intelligent Investor, right? Like, there's the funds, which is great. And there's the subscriptions. Intelligent Investor is a sponsor, supporter of the show. So I'm super grateful for everyone's support and for your support coming on today. I would direct everyone to the Intelligent Investor website. You can have a look at all the different funds, 3 different funds, but you can also have a look at the subscriptions. There's a link in your podcast player if you want to go and have a look at some of Nathan's writing as well. You do the monthly and the quarterly updates and all that sort of stuff. It's all on the website, which is fantastic. Because if you are looking for like 12 to 15 of these names on the ASX, the way I think about it, and I'm doing a plug for your business here, Nathan, but just let me go for a sec. The way I think about it, right? Like I could, the old Buffett thing, I could go from A to Z on the ASX, probably just filter out a bunch of like speculative miners and all that and get down to maybe say 700 companies. But I could probably shortcut a lot of that and just start learning from guys like yourself, Gaurav, the team. And I think no matter where you are on that investing journey, save yourself some time. Go and read what these guys are putting out. And I think you gave yourself a bit of a harsh rap before. You're a bloody good writer, mate. And yeah, I wouldn't. I know there's some great writers in the business, but don't discredit yourself. So go and check out Intelligent Investor. It's all in the show notes there, and you can hear more from Nathan. Mate, I got one more question, which I'm really interested in. I think you've kind of brought a lot of these to the table anyway, but like throughout this conversation, I can tell that you think independently in a lot of facets of life. But the one question that I have is it's kind of forces you to think a bit critically about the way the world works, or even the investing or business world works, which is, what's one thing that you believe that most people would disagree with you on?
Should have done more preparation.
Should have given you more than an hour.
I think this is really boring. This is really boring.
No.
But I think one of the biggest mistakes young investors can make, and I made this too, was just to focus too much on popular financial statistics. So price to earnings ratio is a classic. It tells you very little, really does. Like a price to earnings ratio for Woolies or Coles, where it's a very stable business and doesn't grow very much, it gives you a quick idea of what sort of implied by the valuation. But I think it's easy to use the financials as a crutch. And if the biggest mistake I made early on, and I'm glad I just thought of this, is when you come in, particularly to a professional organisation where you've got investors who've been doing this for a long time, you're very scared about making a mistake. So my boss would always ask me why I was so slow doing my research. It's because I was reading every footnote in the annual report, because I did not want to miss anything. I didn't want to make a mistake. So what that actually typically does is, because, when you're just the average Joe who pays no attention and someone gives you a tip, you don't want to be that guy just giving a tip and just no information. It's just a speculation. But what you do on the flip side is, by being so careful and focusing too much on numbers, for example, is you don't think. So when I was sitting there with CSL thinking, okay, it's $32. I think this is a really great business. It's got some short-term issues that people worry about, but I think they're going to go away. And I think it'll be a $40 stock then. I wasn't imagining, what could this business become in 10 years? What could this business become in 15 years? With Domino's, could Domino's go and be successful in Europe and then go to Japan and then become the number one Domino's franchise on the planet? I just wasn't thinking that big, because you don't want to be that idiot that sounds like an idiot saying this stock could go up 20 times over the next 10 years, because you sound like an idiot. And all the brokers, they've got all their numerical assumptions around the same figure, because they don't want to look like an idiot either, because otherwise people won't invest with them. And if they're wrong, heaven help them, if they're wrong, they lose their job. So that's our old saying. It's better to succeed conventionally than to fail unconventionally. So that idea of really just sit alone in a chair and think about, geez, what could this business become in 10 or 15 years? And that's how you have a much better idea of what businesses have the potential to compound your money at 15 or 20% a year, or whatever that great number is. But you've got to think. You're not going to read it in a book. You're not going to read it in an annual report. You've just got to think by yourself and just imagine. And that's the skill, and that's really hard. But if you've got that, and you can apply that to the great businesses, and you can buy them at a discount, and you've got great management, you can't lose money over time. You just can't.
Yeah. That journey that you just talked about is there's something that I see very often, particularly in investors that are like 2 to 5 years in. Once they discover these tools, it's like I got all these tools in my toolkit, and I'll just go in and just do all these things on all these little details and get really in the minutia, and you really get stuck in it. And then you're like, but there's conflicting signals. You're like, but this one says that is not growing, and this one says it is growing, and this one is like, this is good and this is bad. And you just freeze. And it's like, no, just step back, look at the business, look at it, and just think, where could it go? I think that's the art of investing. And I with writing, let's come back to that for a sec. With writing, a lot of investors, if they're doing their own investment thesis, they're writing it down in a Google document or whatever they're doing, or if they're new analysts, they tell you everything. They tell you, here's the thesis, and it is a university's thesis on this small cap company. Just give me the 300-word version. Tell me what you actually think.
Yeah, no, that's spot on. So I always say, I picked this up from somewhere, but just what are the 3 things that matter? That's it. You do all that work to work out what the 3 things that matter are. and they're pretty obvious.
Mm.
And like you can get lost in the weeds very easily. It's called paralysis of analysis.
Yeah.
But just work out what the three things that matter are, make a judgment call. And if, like, what does Peter Lynch say? If you can't explain what a business does with a crayon, then you don't understand it. So
Yeah.
stay away.
Yeah.
But it's that discipline, that behavior. Steve said to me when I first started Intelligent Investment, I walked in the door, he said, investing is 80% behavioral or psychological and 20% analysis. And if you've been wrong on anything, that 80% is probably 95%.
Mm.
And funnily enough, the older you get, the more experienced you get, it's probably 99%
Yeah.
and 1% analysis, because I've already done the analysis. I know what these businesses do. So it's just about discipline, patience. And at the moment, no one's got any patience. People at the moment, they're just looking for the inflation going down, interest rates going down, the Fed pivot, and then we're away to the races.
Mm.
And no one's got patience. No one wants to think that this might go on for 2 years or more, which I think is quite likely, is slowly, very slowly, given the slow transmission of interest rates, because we've got people on fixed mortgages still going out a couple of years. This could be quite a slow downturn, and people will hate that. People can deal with the Band-Aid getting ripped off. They can't deal with a 1,000 cuts. It's really painful for people, particularly in investing. So, patience is the key on top of all that.
Mm. Nathan, awesome chat. Who would have thought Friday Arvos could be so illuminating, mate? I really appreciate you taking the time to share some of your wisdom, not just with me, but with everyone listening. It's awesome. And everyone go check out Intelligent Investor. You'll find Nathan there. Mate, thanks again for taking the time.
My pleasure, Owen. Anytime, mate.